Hi everyone, hope you're doing well. So, in the last class, I have started this public finance topic, which is very, very important from prelims perspective. And I was at, just let me open that slide. I was at classification of budget into revenue and capital budget. And I have explained the components like what the revenue budget contain and what the capital budget contain. It is very important from all the subtopics I have discussed in the last one, because what they used to give different components, and they used to ask, UPSC used to ask that which component will go under what head. It will go in revenue receipt or revenue expenditure or capital receipt or capital expenditure. So I hope you are clear till now. If not, then please go and watch that session first, because this one is the continuation of the previous one. Okay, I'll start from the next one, receipt and expenditure and its component. Okay, once you understand the logic that what kind of component known as revenue comes under revenue and what kind of component goes into capital one, then you do not need to remember these things especially. Okay, so just try to focus on understanding part first. If not, then try to remember these things. Okay, so, out of the government receipt which comes in budget, there is a revenue receipt and there is a capital receipt. Receipt means the revenue, money you receive, money government receive. Okay, what the money is coming, inflowing into government's account. So, there are two kinds of receipt. First, revenue receipt. Revenue, I have already explained, that day to day expenditure. Okay, so again, the kind of revenue government is getting, it is of two types: tax revenue and non-tax revenue. By name it suggests, just a second, let me clear this slide. By name it suggests tax revenue, the whatever the money you are getting in the form of tax, that comes under tax revenue. There are different kinds of taxes: income tax, direct or indirect, then corporation tax, GST, custom duty, excise duty. I'll be discussing all these things separately. Again, there are non-tax revenue as well, like the different sources of revenue which is not coming from tax, not coming in form of tax. Okay, so they are interest receipt, dividend, user fees, and all those things. Then comes capital receipt. Capital, large amount for the longer period of time. Okay, so capital, there are two types of capital receipt: debt receipt and non-debt receipt. I already explained that those kind of receipt, let me again clear this slide, that those kind of receipt or government which either create liabilities or reduces the asset are called capital receipt. So whatever the money we are getting, either it will increasing our liability, because we are getting that money from other sources and we have to repay it, so we are increasing our liability, or we are reducing our asset. Okay, why? Because we are purchasing some form of money. See, in capital receipt, debt receipt, there are two types of receipt: debt receipt and non-debt receipt. Debt receipt, that means increasing liability. Increasing liability. So that is borrowing. If we are borrowing from IMF, money is being credited into government's account. Money is inflowing. But that is a debt. India has to repay it after some point of time. So that is a debt receipt. It is increasing liability, but again, it is a form of capital receipt. Okay. Then non-government, non-debt receipt, like it is reducing asset, interest receipt, disinvestment, repayment of principal amount. Okay, so see, disinvestment, when government is disinvesting, that means they are reducing their ownership from government company and making it privatized or diluting its shareholding from that public company. Then what happens? Government ownership is reducing, so in that case asset of government is reducing, but that money out of reduced shareholding, what they have sold, the shareholding of that part, that money is coming into government account. Okay, so again it is reducing asset, but money is coming into government account, so that comes under capital receipt. Interest receipt and repayment of principal amount. Okay, see, one thing you have to focus, that when we are taking loan or when we are giving loan, okay, so principal amount of loan, whatever, if we take or if we give, that principal amount goes into capital receipt. Okay, but when we are paying interest or getting interest, that will come under non-tax revenue, so that will go under revenue receipt. Okay, please focus on it because question comes used to come from this aspect and you need to be clear about it. Principal amount goes into capital account, but the interest amount goes into revenue account. Okay. Then comes government expenditure. Again, these are two types: revenue expenditure, capital expenditure. Revenue expenditure, day to day expenditure, salaries per month, pension per month, subsidies based on the value, based on the volume, on different kind of things. So they are related to day to day financing activities, right? Like not financing, but day to day money expenditure activities. Then comes capital expenditure because they are huge. Okay, so debt repayment, road buildings, machinery, all these things comes under capital expenditure because we are making it once in a while and it is taking a lot of money into it at one point of time. Okay, then revenue budget, revenue receipt and revenue expenditure. I hope you are clear about it. So there is no need to repeat again and again the same thing. So I am just moving forward because in the end of this slides, you will be getting much more important to learn. So I don't want you to get exhausted till the end of this lecture. Okay. So please save your energy for now. I'll be focusing on what is very important. Revenue receipt, tax, non-tax, same thing, no need to go into detail. Then comes tax receipt. I have already explained you what is tax revenue, what is non-tax revenue. So those revenue which is coming in form of tax comes under tax revenue. So again, from now onwards, I'll be discussing about taxation process. There are two kinds of tax, direct or indirect tax. You are aware of it. There is no need to explain a lot about it because you know. Okay, so let's focus on what is the basic difference in terms of economics language, because in economy things are very simple and related to your daily life, but they becomes tough once we are using economics bookish language. Okay, so you need to focus on those things. See here, impact and incidence, impact of tax and incidence of tax. There are two things here. If you are clear about it, you will be differentiating between direct and indirect tax in economics language as well. Impact of tax means who is getting burden or who is getting responsible to pay tax. For example, if you are a government, you are asking me to pay this amount of tax, so the impact of that tax is on me. Okay, so the person who is responsible to pay tax, that comes under impact of tax. They are liable for that impact of tax. But suppose you are asking a tax from me, but I am diverging it to different people, because suppose I am doing some sort of production and you have imposes some production tax on me, so I'll be transferring that tax amount to my consumer. Okay, so I'll be charging a small portion of tax from them as well. Okay, so in that case, incidence of tax is not on me but on that person who is actually bearing the tax. So if being a producer, I am charging extra tax percentage or tax prices for my consumer, then consumer will be having this incidence of tax. Okay, so impact, who is actually responsible for tax, incidence, who is actually bearing the tax. Okay, so in direct tax, what happens is impact and incidence of tax is on same person. Okay, so income tax, suppose income tax, government is imposing on me, being like if I am at above certain income level, government is imposing tax on me. Okay, so in that case I'll be bearing that tax as well because I cannot transfer to other people. So in that case, impact and incidence is on same person, so that called direct tax. But in indirect tax, impact is on different person and incidence is on different person. Okay, impact is on producer, suppose. Okay, but incidence is on consumer, like GST. Whatever the GST we are paying, as a consumer we are paying. If they are charging even from producer, they will get credited in form of input tax credit. Okay, but what happens is, as a consumer, we have to pay 0%, 5%, 12%, 28% of GST. So incidence is on consumer, but impact is on producer. So that called indirect tax. So this is the basic difference, impact and incidence. If you are aware, then you can write the difference between two in economics language as well, and that will sound really good to examine it, even from a mains perspective. Okay, that's it. I hope you are clear about it. Impact of tax, same thing. Person responsible for payment to the government, same thing. Incidence, the burden of tax cannot be transferred, is borne to the person paying it, that is called direct tax. The ultimate burden of the tax is borne by the consumer, indirect tax. Same thing I have already explained. Okay, types of tax, progressive and regressive. Okay, see, suppose there are two options, um, income tax and GST. Okay, so there is a different kind of slab in income tax. Up to 12 lakh you'll be getting this much percentage, up to 50 lakh you'll be getting, like, you will be paying this much of tax. Above 50 lakh you will be paying surcharge as well, you will be paying cess as well. So different kinds of more amount of taxes will impose based on your income. If you are earning less, you will be paying lesser tax, but if you are earning more, you will be paying more tax. Not in just form of, like, suppose 10% of 1000 is 100 rupees. Okay, or let me, it is not being written. Why? 100 rupees. Okay, but 10% of 10,000 is 1000 rupees. But they, like, progressive tax, this is not called progressive tax, this is proportional tax, that you are paying 10% exactly of your earning amount. That is called proportional one, but not progressive. When it called progressive, because you are earning less 1000, so you will be paying 10% of tax. But once you are earning 10,000, that means more than the expected amount, then you will be paying probably the 12% tax. So in that case you will be paying 1200, not 100. If you are 12 not 1000, if you are paying 1000 rupees, that is 10% of 10,000, that is called proportional tax. But if you are paying more amount of percentage, tax percentage as well, that means 1200 in this case, that is called progressive tax, because you are earning more, so your paying capacity is higher, so you can pay more tax as well. Okay. Regressive. Regressive means, this one, proportional tax are called regressive because if government has said that everyone has to pay 10% of their income, that is called regressive. Because for a person who is earning 1 lakh rupees, or not 1 lakh, they are earning 10 lakh or 50 lakh rupees, for them 10% is negligible. They can pay even more and their standard of living is very high. But for a person who is earning 1000 rupees or just 100 rupees, for them this 10% is very much higher, right? So they cannot, their paying capacity will be very less, and they cannot afford to get their standard of living, better standard of living in that case. So that is called regressive tax. So I hope you are clear. Progressive means if you are earning more, your paying capacity is higher. But regressive means you are being charged irrespective of your level of income. There is a, like, sense of equality, but that is not equality. There is no equity as well. Okay. So in case of GST, for example, there is a I don't know exactly the amount of taxes charged on it, but probably the 12% charged on sanitary pads. Okay. So for a person, for a woman who is earning 1.5 lakh a month, they can afford that sanitary pads at affordable rate. But for a woman, daily wage earner women, for them this 12% would cost very high. So in that case, it is called regressive tax, because probably the higher earning women can afford it, but the lesser earning, lower earning women cannot afford it. So they are not purchasing it, or even they are purchasing it at the cost of their other basic needs. So that is called regressive tax. So I hope you are clear about between these two, progressive and regressive. So progressive tax is one in which upper income families pay larger share of their income in tax than do those with the lower income. Regressive tax require the poor and middle class to pay a larger share of their income in tax than the rich. Same thing I have already explained, that's okay. Then types of tax, progressive, regressive, where the tax rate increases. Same thing, tax system where the same tax is applies to everyone regardless of their income or ability to pay. That is okay. Then effect on income group, the wealthier of the individual, the higher the percentage. Same thing. I have already explained all these things, so there is no need to explain again in form of words. Nature of words, direct tax such as income tax are generally progressive. Regressive tax, direct tax such as GST are generally regressive. I have given you the example as well. Then proportional tax and digressive tax. Proportional tax, I have already given you the example in the beginning only. A tax system where the same fixed percentage of income is applied to all individuals regardless of their income level. A flat 10% income tax rate. Okay. Digressive tax that initially increases progressively but becomes a flat beyond a certain income threshold. Okay. So in proportional tax, it has been said that 10% of whatever you are earning that will go into in form of tax. But digressive tax means up to 50 lakh you will be paying 10% of your tax, but above 50 lakh whatever you are earning you will be paying 2% of tax on that amount. So in that case what happens is this is just opposite of progressive tax. In progressive tax what happens is above 50 lakh if you are earning you will be paying even more. You will be paying probably the 12% if you were getting charged 10% earlier, right? So you are getting higher tax percentage at that point. But in digressive tax you are getting lesser percentage after a threshold, income threshold. So a tax system where rates increases up to a certain level and then remain constant regardless of further income increases. Okay, nature of tax. Proportional tax ensure uniformity but may not address income inequality. Okay, again because to address inequality you need to have progressive taxation which is present in case of India. Digressive tax, a combination of progressive and proportional taxation partially addressing equity while maintaining simplicity. Okay, practical context same thing. Direct tax. Okay, so these are the examples you can use anywhere. Income tax, corporation tax, security transaction tax. Security transaction comes in your when you are dealing in stock market, you are purchasing a share and then you are selling it, you have to pay certain amount of tax on that. Security transaction tax. Then capital gain tax. Capital gain tax I'll be discussing I think separately in different slides, but just for a given context. Capital gain tax, you are earning a huge amount after selling your property such as house, such as land, or such as vehicle. Then you are earning a huge amount at one point of time, so at that point you have to pay certain amount in form of capital gains because you are gaining capital. Dividend distribution tax, again when company is having some profit, okay, they are distributing in some form to their employee in form of dividend because they cannot distribute profit to their employee. They used to pay salaries to their employee, okay, but suppose they are getting huge profit in 1 month, so they want to give surplus amount to their employees as well, so they used to give in form of dividend. So being employee, if I am getting dividend from my company, then of course I have to pay certain tax on it, so that comes under dividend distribution tax. Okay, indirect tax, GST, custom duty, excise duty, service tax, and VAT. Okay. Okay, direct tax by union government and state government, there are different kinds of tax both government used to charge. So on income, what union government used to charge, corporation tax, like if you are running a company you have to pay corporation tax on company's profit. Then minimum alternate tax, tax for the companies with low taxable income. Suppose government is saying like after 50 lakhs or 40 lakhs if you are earning you have to pay this much amount of tax, suppose 25% or 30%, whatever the rates are prevailing at that moment. But suppose your company is earning lesser than that threshold, then you are not going to escape from taxation system, you have to pay some amount in form of minimum alternate tax. Okay, then income tax for the individual. Then capital gain tax on profit from the sale of assets, same thing. Earlier dividend distribution tax was there, what I was explaining earlier, but later it got abolished because at that time when dividend is being paid to employee, at that point of time new mechanism came, tax deduction at source only. So whatever the dividend you are getting, that is tax is already deducted from that amount, and company is responsible to pay that tax amount to government later. Because if you are getting a rebate, you are not liable to pay that tax, then you can get that input tax at that after a certain point of time once you file ITR. Okay, so later it got abolished. I think it is there in coming slide. Then direct tax by the state government. Agriculture income tax, state government used to charge. Then professional tax, a tax on profession capped at 2500 a year. Suppose I am a doctor and I am not being employed, I am being self-employed and I am running a clinic in my own home. So how government is taking a tax from me, because there is no fixed criteria that how much I might earn. So in that case, I used to pay professional tax because I am having some professional degree and I am earning out of it. Okay, so CA, lawyer, or doctors, or even small like professionals, they used to pay this professional tax. So this was on income. On asset and transaction, security transaction tax already explained. Commodities transaction tax on commodity trades. Okay, wealth tax got abolished. Banking, cash transaction, estate duty, all these things got abolished. Land revenue tax on land and ownership. Okay, state government used to charge it. Stamp duty and registration fee. Suppose you are purchasing a home or purchasing a land, then you at that point of time you used to pay stamp duty and registration fee. So all these things will go into state government's account. Okay, land comes under state subject, so all these things, all the revenue related to it will go under state's account. Then property tax levied on urban properties. Okay, then expenditure, all these things got abolished. Road tax, toll tax levied on vehicle ownership varied by tax. Okay. So just try to have a broad idea that which kind of tax will go into union or state government account, so that you are not getting confused, and probably there is a lesser chances of UPSC being asked this kind of question. But still, just have a broader idea so that you are not getting confused. Then merits and demerits, I think it you are aware of it, but just for a quick recap. Merit, direct tax are progressive. They promote civic awareness, because if I am a responsible citizen, I have a patriotic feeling, I will be paying my tax. Okay, encourage saving and investment, because through deduction exemption of schemes like NPS and LIC. Suppose government used to give some rebate based on the investment you had done. Suppose I had 1,000 rupees, okay, and I have invested in mutual funds and different kinds of fund. Okay, but still I'll be getting charged of it. Why? Because the government wants me to like increase my investment in national pension scheme or LIC kind of a scheme or insurance related activities. So they are paying exemption on these things. They are giving exemption that if you are investing the amount in NPS or LIC, suppose you have invested 200 in these things, then you will be charged tax only on 800. Okay, so there are list of different kind of investment option. If you are doing it, you will be getting tax exemption of that amount. Okay. Then tax revenue increases, public income grow, ensure adaptability to economic growth. Taxpayer know when and how, what amount to pay, ensure clarity and predictability. And tools like Tobin tax can help reduce volatility in international currency exchange. Okay, Tobin tax, I think it is going to come in coming slides, so I'll be explaining there. Okay, then demerits. Externalities are ignored. For instance, author of academic book, I am having a bad health, so I'm really sorry if my voice breaks down some at some point of time. I'm really sorry in the beginning only. Externality are ignored. For instance, authors of academic books and film star promoting a harmful product are taxed equally. So externality, suppose I am selling alcohol, or on the other hand, some other person is selling some sort of apple juice. So both are taxed equally. But if we look at the health perspective, both are having a different impact. Apple juice is giving me a health benefit, whereas alcohol is giving me a bad health. Then both are taxed equally, so that is being ignored. Positive versus negative externality. So in that case, government used to come up with different kinds of things, that they are charging higher taxes on sin goods like cigarettes, like alcohol and all those things, but they are charging lesser tax from a good, like better goods. which are good for our health. Okay, so that happens. Does not account for an individual hardship. Carpenter and landlord may pay the same rate despite differing circumstances. Okay, same thing. High tax may discourage work and deter foreign investment. Tax base is narrow as poor individuals are excluded. Expanding it would require significant administrative effort. Vulnerable to litigation, tax evasion, and exploitation of loopholes, they are there. That will be existing even if you come with the best kind of rules as well. Then union tax, surcharge and cess. This is important to understand. Surcharge means tax on tax. I have already explained in the beginning that if you are earning more than 50 lakh, okay, then you have to pay surcharge as well. Okay, suppose your tax liability of 50 lakh, I mean, I am giving you a hypothetical example. Suppose you are having a liability of 50,000 tax, if and you are earning more than 50 lakh, so in that case you will be getting surcharge of some fixed percentage, suppose 2% on this 50,000 as well. Okay, so you will be paying 1,000 again 1,000 extra. So total your tax liability will be 51,000, not 50,000, because this 1,000 is a surcharge. So tax on tax. Okay. So additional charge of the tax amount effectively on tax credited to CFI but not shared with state. This is again, I'll be discussing in the coming one. But just for now, try to understand what is surcharge and what is cess. Surcharge means tax on tax. There will be fixed percentage of tax on your total tax liability, and that will add into your tax liability, and you will be paying more tax. Surcharge. Okay. Cess means, suppose government has put some education cess on you. Okay, 2% of education cess. So whatever the tax liability you have, suppose this 50,000, just a second, my writing pen is not working. Suppose you have a tax liability of 50,000, so you have to pay 2% education cess on it. So this 1,000, whatever the government is charging, this will be utilized for that education purpose only. Education purpose only, because this is a education cess. So this is a purpose specific tax. This is highly relevant from a prelims perspective. So try to understand it. If you have any confusion, please clear it right now only. Surcharge means that the government is charging you extra amount because you are earning more than the expected amount, and you should pay that amount. Will be going into central government account, and they might use it for different purposes. Cess is a purpose specific tax that government is charging, central government is charging, and they will utilize that money for that particular purpose only. Okay. A tax with a specific purpose computed on a tax plus surcharge and with funds often routed to public account for targeted use. Purpose primarily for general use. Exception include social welfare surcharge, explicitly used for welfare schemes. Surcharge not shared with. Okay, so this one again, try to remember it, that whatever the amount you are getting in surcharge or cess, that will not go into state government's account. It will go into central government account only. Okay, so there is a means related debate here, and they won't ask this directly, but you can use this as a point in your mains answer writing, that there is a fiscal federalism concept is going on. State is getting lesser amount. What should sorry, what should they be getting? Okay, so what happens is, government has told that 41% of total tax amount will go into state account. Like, if I am paying 100 rupees in form of income tax to government, out of that 100 rupees, 41 rupee will go to state account. Okay, and then rest of the amount will stay with the central government. Okay, so what happens is, central government is charging lesser percentage on of tax, and then they are charging higher surcharge and cess from that person. So in total they are getting higher tax, but when it comes to distribute among state, they are distributing lesser amount. Why? Because most of the amount they are getting in form of surcharge and cess, which is not being distributed with state. Okay, so states are demanding that you are charging more in surcharge and cess. Please pay some amount to us as well, or you can less this percentage, this tax percentage of surcharge and cess, and try to charge more in tax percentage so that we are getting that amount. I hope you are understanding this point. Okay, suppose let me make it clear to you, because this is a debate going on. State often used to demand this. Suppose government is charging 10% income tax, 2% surcharge, and 1% on cess. This is the ideal case scenario. Okay, states are getting share from this 10%. 41% of total tax received, they are getting from this amount. This 3% is going into central account only, not in state account. Okay, what current government is doing, that they used to charge 8% in income tax. Okay, then 3% in surcharge, and then 2% in cess. So overall, if you see that tax liability on a person is same 13%. Here it is also same. Okay, 13%. But the state share has been reduced. Okay, so that is the point of contention between the state and the center. Because of the 15th Finance Commission, they are getting 41% of that total tax amount only, not of surcharge and cess. So probably in the coming one 16th Finance Commission, some suggestion might come on this topic as well. So you have to keep a close eye on those 16 Finance Commission recommendation and use it in your mains answer writing. I hope you are clear about it. Then, example, income tax, GST, custom duty, social surcharge, social welfare surcharge, 10% on imported goods. Then cess, road infrastructure cess, health and education cess, same thing. Fund allocation, I have already explained. Whatever the fund government is getting in form of revenue or capital receipt, all things will go into consolidated fund of India. Okay, then surcharge also goes into consolidated fund. Cess also goes into consolidated fund initially, but later, because it is a purpose specific, that amount will transferred into specific funds in the public account. Okay, and that will be utilized for that particular purpose only. And these two things will stay back in government account, and they can use it whenever they are need. Then comes corporation tax. Now I'll be discussing each tax separately. I'll be going bit fast because there is lesser utility from a prelims perspective, even from a mains one, but just have a broader idea. Corporation tax are like the government used to charge different tax rate from different one, and these particular things are known. You don't need to remember why, because each year with coming budget there are different types of taxes or different types of tax rate are being charged. So you just need to look at the current budget, what is going in 2025. Okay, and try to get the idea that which kind of corporation company are getting which kind of tax. Okay, so no need to remember this one, but just try to understand that there is a different kind of corporation tax being charged from a new Indian manufacturing company or existing manufacturing company, then from foreign company, then zero profit companies and all these things. So there are different tax being charged from them as well. Just a second. Then corporation tax on startups. So to encourage startup, government used to charge different tax or give used to give tax incentive to those startups as well. So as per current norm, if it is not going to change in current budget, then I'll be discussing those budget in the separate lecture. But for now, if it is not being changed, then government used to give tax incentive to startup up to 10 years. Okay, so if I am started a new startup, so I might get tax incentive till 2035. Okay, startup is a company that is less than 10-year old, has turnover below 100 crore. Again, there are conditions. It should be lesser than 10 year, and it should like turnover should be below 100 crore. If I have a turnover of 500 crore, that shows that I have a higher paying capacity as well. So I should be paying tax in that case. Two condition: it should be lesser than 10 year, it should be below 100 crore. The government supports startups through Startup India scheme. Startup can claim 100% tax deduction, tax holiday on their profit for 3 years within the first 10 years. So this incentive is given for 3 years. Like if I am earning, like I have started startup in 2025 till 2035, I have a 3 years in which I can demand 100% tax deduction. Okay, not all 10 years, but for 3 years. Then comes angel tax. Angel tax, tax on angel investor. Okay, who is called angel investor? I hope I have just a second. I hope I have explained angel investor as well. Suppose I am going to start some millets business, okay, and I need a investment, but I don't have money. Then some person will come like an angel and they will invest in my company. So they are called angel investor. That they are coming like a god for me because I was in dire need to start a business and they have funded my project. They have funded my business and I am running a business. So in that case, whatever the investment I am getting, there will be a percentage of tax will be charged from that amount, and that is called angel tax. Okay. In 2012, UPA government included angel tax, which is required startup companies to pay 30% tax and penalty on investment they receive from angel investor if the investment were deemed suspicious. Okay. The tax was intended to target questionable funding but caused controversy as it was seen as a potential hindrance to startup growth. The tax was later removed in 2024 budget, so it is now not in process, but it was there earlier. Probably UPSC won't ask this because it is outdated now. DPIIT under the Ministry of Commerce oversees such policies. Okay. Minimum alternate tax. I have already explained you that those companies which are earning lesser than the threshold tax income threshold, then they will be paying minimum alternate tax and they will be free from all other liabilities. Some business make profit but use tax deduction, exemption, depreciation, accounting tricks to show no taxable income and avoid paying corporation tax. To address this 1996 budget, introduce MAT at 18.5%. Okay, a book profit of these zero tax companies. So minimum MAT of 18.5% if you are paying, then you are free from other kind of liabilities. Modi government later reduced MAT to 15%. So now it is 15%. Similar tax called alternative minimum tax is applied at 15% to cooperative societies. Okay, so UPSC might ask the difference between MAT and AMT. Minimum alternate tax is for all other companies which are earning lesser than income threshold, which is for taxable income. Okay, but alternate minimum tax are those tax charged on cooperative societies like Amul or IFCO and other cooperative societies as well. Okay, so AMT, alternate minimum tax, minimum alternate tax, both are just a difference of on which kind of companies it is being imposed. That's it. Then capital gain tax, I have already explained that if you are selling some sort of property, your property in form of vehicle, land or house, then you will be getting a huge profit at one point of time. So at that time, government will come to you and will say that you have earned a lot in a single time. So you should pay this much amount of tax to me. Okay, so what is capital gain tax? Any profit or gain generated from the sale of capital asset is called capital gain tax. Type of capital gain tax: short-term capital gain tax, long-term capital gain tax. See, to avoid this, what people used to do, suppose you are purchasing a house. So your house might go up to 55 or 60 lakh. So in that case, what happens is, if that seller who doesn't want to pay capital gain tax, then they will say that I will sell this house to you up to 60 lakh, like for 60 lakh, but you will show in government registry paper, stamp duty paper, that you are purchasing this house for 49 lakh or 47 lakh. Okay, not more than that. Rest of the amount you will be giving me in cash form. So this is kind of loophole they used to do. Why? Because if they are selling at a original price on government paper as well, then they have to pay stamp duty plus 30% of capital gain tax as well. So they have to pay higher tax. But if they are selling for lesser than 50 lakh, then they don't have to pay this capital gain tax, whatever the amount they are charging, 15 to 22 or 30%, whatever. So they won't be paying this capital gain tax. They will be paying only the stamp duty or whatever the going rule as per the rules. Okay. Capital gain tax is paid when owner makes a profit by selling capital asset like land, property, jewelry, painting, vehicles, machinery, patent, trademarks, share bonds, or other securities. The tax rate depends on how long the owner held the asset before selling. Okay, so short term and long term. Short term capital gain tax are sold within the first 12 months of ownership. Long term capital gain tax are sold after the 12 months of ownership. So the basic difference: short term before 12 month and after 12 month long term. Simple. Okay. Then, depending on when you sell an asset, you will pay either long term or short term capital gain tax, but not both. The holding period of tax rate vary for different type of assets. Okay. In budget 2022, Bitcoin, NFT, or other virtual digital asset was charged as a 30% capital gain tax and 1% TDS to applied on a trade transfer. See, capital gain tax is not same on all kind of activities. In some in some cases they are charging 15%, in some other cases they are charging 22%, and in some they are charging 30% as well. So mostly, if they are charging 30% capital gain tax, so they are just trying to discourage those kind of investment at a broader level. Okay. So Bitcoin, NFT, virtual digital asset, they are kind of risky kind of investment. So government does not promote it. So that's why they are saying if you are earning 100 rupees out of these things, then give 30 rupees to me. So they are charging 30% capital gain tax. It is a other method to control use of those items into Indian economy. That is also one of the reason why government used to charge higher tax percentage on alcohol as well. Okay, one thing is that they are getting revenue, but other thing is that if they charge lesser tax, then probably people will consume more because now they will be getting at a lesser price all those alcohol. Ca- Capital gain tax or share market. My voice is breaking in between. I'm really sorry for that, but because I am not having a good health right now. But I hope you are being clear with my voice. If you have any doubt, you can directly contact to team and can reach out to me. I'll try to explain these things again. Okay, but just try to ensure that all these concepts are being clear to you, because you cannot learn each and every item. You just used to put logic on different kind of things. So you need to know that why these things are being charged at higher percentage and why these things are being charged at lesser one. So clarity is very important, essential aspect here. Okay. Then capital gain tax on share market profit as per the budget. Short term capital gain 15%, long term capital gain they are charging 10%. So again, on different kind of things they used to charge different one. In share market they are charging this percentage. Reason justifying tax increases by government, rising share market profit, same thing for mains one, not needed now. Indexation benefit, cost inflation index. Indexation benefit means it adjusts the profit according to inflation changes, reducing the taxable amount on long term capital gain. Okay, so indexation benefit, it just adjusts profit according to inflation changes. Suppose you are earning like you are earning a profit of 100 rupees this year and earning a profit of 105 rupees next year, so there is an increment of 5 rupees. But if you see there is a exist like a prevalence of 6% of inflation, so probably in real terms you are not getting higher profit, you are getting lesser profit because there is a uh, inflation concept in between. So indexation benefit tries to ensure that inflation is being adjusted, and whatever the price you are getting or whatever the gain you are getting, that should be getting in real terms. Okay, I hope you are clear about the difference between nominal and real terms. Nominal means whatever the current value, real means inflation adjusted value. Okay. Then asset debt mutual funds. Before indexation, it was allowed. After indexation, allowed. No, no, it was not allowed. Okay. Same thing. You do not need to remember these things. They are not needed. Just try to understand what is indexation benefit. See, in economy, they are mostly asking the concept, and if not concept, then they usually ask those kind of things which either you can solve by logic, or you cannot solve at all. Even coming from economics background, I find very hard to solve those kind of questions because they are highly factual in nature. You cannot learn that thing. So try to focus on concept and try to put logic as well. These two things can help you to deal with economics. Okay, so no need to learn these things. Then indexation benefit in property CGT after budget. If home property sold after 24 years of ownership, then its profit is subjected to long-term capital gain tax. Okay, home property sold after 24 years. Okay, government allows the person to adjust the profit against impact of inflation, and this is called indexation benefit as it reduces tax liability to the seller. Why indexation benefit? Suppose your house was like you purchased house in 2000 at 10 lakh. Okay. Now the same house is having 50 lakh is as a value. It is having 50 lakh worth of value now after 25 years. But if you put index like inflation, if you adjust inflation, you will find that 50 lakh is not the current actual value. After adjusting, it might come up to 25 lakh only. So you will be paying tax of this 25 lakh, not for 50 lakh. Okay. So this is the benefit, indexation benefit. Income tax. Income tax, same thing, you are aware. James Wilson, a financial member of Council of India, like income tax came during Britishers' time in 1860. Okay, and they were trying to recover their loss, whatever they got in 1857, Sepoy Mutiny, that 1857 freedom struggle. Then in on 24th July, it is observed as Income Tax Day, Aikar Divas, 24th July, because it was get imposed on that same day only. Okay, there are different kind of slab. It used to get changed each year with budget, so no need to explain learn these things. Try to focus on 2025 budget only. Okay, and most of the question will come from that one only. Some important terms: deduction limit. There are maximum limits for deduction like LIC and PS. Even if you invest more, you won't be getting higher deduction. Up suppose government has said that if you are investing in LIC, I'll be giving you a tax deduction. Then being a more greedy person and I don't want to pay any tax, then I would spend my whole income into LIC only. Then will it work for government of India? No. They want some revenue and they want some tax payment from, so they are giving deduction limit that up to this point, if you are investing in this one, you might get exemption, but above than this, you won't be getting and you have to pay tax. Then NTR deduction, new tax regime, you won't get deduction for LIC. So there was like in 2023, 24 only, there was two kind of old tax regime and new tax regime. So in new tax regime, you were not getting any deduction, but you were paying lesser amount of tax percentage. Okay. But in old tax regime, you were paying higher amount of tax percentage, but you were getting different kind of deductions. So there are two options available, whatever you want to choose. Okay. In 2025, they will be coming with some more explanation as well. So you can skip this part from a to learn, and you can focus on current year's budget only. Tax rebate, there are tax rebate. If someone has to pay 20,000 tax in new tax regime, they won't receive 25,000 rebate. The rebate can only reduce tax to zero, not below it. Rebate means, tax rebate means chhoot, simple sense, chhoot, that I have a liability to pay 5,000 of tax, but government has given me deduction, and they are saying that you are getting a tax rebate because your income is below taxable threshold income, so you are getting tax rebate. In that case, you do not need to pay that tax. Okay. That income tax rebate applies only if taxable income is up to 5 lakh in old tax regime, and 7, this one keeps changing, no need to learn. Disposable income means, suppose I am earning 1,000 rupees. Okay, but I have to pay 100 rupees as tax to government as well. So my current income after paying tax would be 900. Okay, so this 900 is the disposable income. Okay, then revenue forgone in new tax regime. No need to explain. No need to learn. TDS, tax deduction at source. I was giving you the example of dividend as well. Okay, suppose government company is earning a huge profit and they are going to distribute some dividend to their employee. Okay, but employee does not want to pay tax on those dividend. Then what company will do? It is a loss for government. So government is giving responsible or making responsible those companies to pay tax. They are saying that if you are giving them dividend, you are paying them extra amount, then you should pay some tax of that amount as well. If that taxable income is below the threshold of that person, like suppose A is an employee of that company ABC. There is a company ABC. Okay, A is an employee. A used to get 10,000 of salary. ABC has earned huge profit in 1 month, so they want to give dividend to A 2,000 extra. So they will be charging some amount from it. Suppose 5% of this 10,000, that will be 100 rupees. So they ABC will charge 100 rupees from A and will give 1900 only to this A. And this 100 rupees will go into government account. So this is called tax deduction at source. This source, because for A, this 2000 income was the source. Okay. So tax deduction at source. Now, later what happens is A income, suppose A's income is 11,900 per month, but his income is below the taxable income threshold. So A is not responsible to pay tax. He is getting tax rebate in that case. So what happens? Then A will file ITR and demand that this 100 rupees has deducted from my dividend, then I should be getting this and government will refund this to A. So that happens. But it will happen only when A's income is below taxable income. If A's income is already at higher level and he is paying a tax, then this amount won't be coming back to A. This amount will go into government account only and government use it. Okay. So tax deduction at source, that whatever the amount you are getting, you will be getting those amount after deducting tax as well. Okay. The payer deducted the tax from the payment. Payer deposit the same to the credit of the government. Payer file return to TDS. Payer issues TDS certificate to the payee. Payee claim refund to of TDS in his return. So this one, TDS certificate, A will show to government that I have been paid this through my company and I want this refund, so they can get refund, but only in only case when they are paying income tax. TCS, tax collected at source. Okay, so this was tax deducted. This is tax collected at source. Okay, this happens. Suppose I am a retailer. Okay, you are a wholesaler. Okay, so in that case, what happens is I have a GST. I am running my own company and I have to pay GST, but you do not have a GST. You don't. Okay. So at that time, whatever the amount you will be getting, because there is a concept of input tax credit. If producer or wholesaler has paid that tax amount, they will give this input tax credit certificate to retailer, and retailer can demand refund from government because they have to pay extra tax. But in this case, wholesaler is not having GST and wholesaler is not getting giving any tax to government, so the whole burden will lie on retailer to pay all those taxes. So that share of tax from the wholesaler part, retailer will charge from wholesaler. Okay, so this one called tax collected at source, that retailer got some sort of goods from wholesaler at this point of time and they will get some deduction in form of payment because that amount, tax amount, has been collected here. Okay, so they will collect this tax from wholesaler and will pay to government. Okay, so this one is seller, this one is buyer. So I explained in terms of wholesaler and retailer, but tries to understand in buyer and seller form, simple sense if you want to get understood. Then being a buyer, if I am purchasing some product, I am not going to government and paying the part of that tax amount. So at that point of time, seller is paying those taxes, but they are charging tax from me in form of consumption, in form of service. Okay, so that, suppose, simplest example, we are ordering some food from Zomato or Swiggy, we are going to restaurant, they are charging CGST, SGST. So what they are doing, they are doing tax collected at source, because I am consuming. At that point of time, they are charging tax collected at source, and seller is collecting those taxes and paying to government. The restaurant owner is charging that amount and paying to government. I hope you are clear about it. Difference TCS and TDS. TDS deducted at source, who collect or cut the tax, buyer or goods and services collect this. Like who cuts it? Buyer of goods and services. From whose payment before making payment of the seller. You will be getting confused from this one. Don't, no need to go into that one. But just try to understand what is tax deducted at source and what is tax collected at source. Simple thing. Then miscellaneous, Tobin tax. Tobin tax, Robin Hood tax. Tobin tax means a small tax proposed by James Tobin uh, in 1970 on currency exchange. Its purpose is to discourage short-term speculative investment and stabilize global economies. What happens is, sometimes there are speculators who are market players, you can say. They are very experienced, they are expert at it, and they used to manipulate currency prices. At one point of time, they will demand currency to large extent, and the price of that currency will go high. At other point of time, they will start selling that currency and reduce their prices in the market. And meanwhile, in this process, they tries to earn a lot of money in that process. Okay, so government has said that if you are doing this and if you are earning this, then you have to pay some tax of your earning to me. Okay, so government, on the one hand, they want to discourage this short term speculative investment. On the other hand, they are trying to stabilize global economies as well, because suppose if some speculators are doing this with Indian rupee, what how much the volatility Indian rupee will have, and it will directly impact India's economic growth and stability as well. Okay, so government is discouraging this kind of thing. That's why they used to charge Tobin tax. Okay, Robin Hood tax, that if you are doing bad and if you are earning from that bad activity, then you have to pay tax, and I will collect this tax and will utilize for some betterment of my country. Okay, its purpose is to discourage short term, this one, aimed at reducing currency volatility, prevent capital flight, and stabilize exchange rate and stock market. In India, currency conversion are taxed under GST, but other countries may apply it as a direct tax. Security transaction tax, as tax on sale and purchase of securities. This one I have already explained. Let's leave it. Commodities transaction tax on non-agricultural commodity traded on commodity exchange, typically levied on a. See, there are different kinds of share market as well. There is a commodity market. There is a forex market. There is a secure share market as well. So in share market, you are being charged from STT. In commodities market, you are being charged from CTT, and in forex market, if you are earning huge, you are charging Tobin tax. Okay, simple. Stamp duty, if you are purchasing any property, that means government is taking you as a value investor, and government is thinking that you have a lot of money and you should pay some amount to them in form of stamp duty. So charge on the value of shares, bonds, securities, immovable properties, building, and certain legal agreements such as rent agreement. Okay. Then indirect tax. Now I have discussed a lot about all those types of direct taxes. Now indirect tax, in which impact and incidence is on different purpose. Indirect tax are tax levied on a goods and service rather than on income or profit. They are collected by intermediaries. I mean, they are not getting collected by directly by government, but the other person who is getting involved in the process. Okay, who bears the tax burden? Example include GST, custom duty, and excise duty. They come under the purview of Central Board of Excise and Custom. So I have already explained that in Department of Revenue there are different form of committee or different type of department. CBDT, Central Board of Direct Tax, for all sort of direct taxation, and Central Board of Excise and Custom department for indirect taxes. They are mainly of two types: specific tax and ad valorem tax. Ad valorem tax based on value of goods and services. If you are producing 100 rupees worth of goods and services, you will be paying suppose 18% of GST. But if you are producing suppose 1000 rupees of the goods and services worth, then you will be paying higher amount. So ad valorem tax based on the value of goods and services. Okay, of course it is difficult to administer because to keep a eyes that how much one have produced, there is a lot of loopholes. So to cover those loopholes, it is important to it is important to keep an eye, but that is difficult to administer. Okay, then specific tax. Tax imposed on a specific quantity of goods and regardless of value. So a specific quantity, that if you are producing 10 units, then you should pay 10 rupees of tax. If you are producing 50 units, then you should pay 20 rupees of as a tax. So it depends how much the quantity you are being produced. So ad valorem based on value, specific tax based on quantity. Burden of indirect tax. When the government increases GST on a product, packaged snacks, from 12 to 18%, business can respond in two ways. Burden of indirect tax. See, there can be different burden, burden can be put on consumer, burden can be put on producer, burden can be put on different person who is involved in the process. Okay, so what are the influencing factor that who is going to pay how much the tax burden, tax liability? Okay, so influencing factor are forward shifting and backward shifting. There are two types. Forward shifting, the business raises the product price to maintain its profit margin. Suppose there is a production at a producer level, any biscuit is worth of 100 rupees. Okay, after government has charged 5 rupees. So if producer is charging 105 rupees for that product, that biscuit, that means they are doing forward shifting of that tax because their profit margin is same. Earlier it was 100, even now it is 100. Okay, so forward shifting, they are shifted tax liability to consumer. Backward shifting means they are shifted their prices to by reducing their input, by reducing their wages of labor. So business keeps the product price unchanged to retain customer but reduces costs such as cutting down on advertisement expenses to maintain profit margin. So whatever the unnecessary expenses they are thinking that this is not needed for now, they can cut it, but they maintain the same price because they might be having a huge competition, and if they increase their prices, probably the other competitor will take over the market. Okay, so forward shifting and backward shifting, I hope you are clear about it. Then merits and demerits of indirect taxes. Merit is that it is convenient to collect because it is doing at one each point of time. Collect as trader, act as an unpaid tax collector. Government has not no need to appoint some other person, like in income tax department happens that they used to take all these things. In this one, traders or a company is responsible to pay tax, so they used to collect tax from consumer itself. Okay, it has a broader tax base as it applies to consumers, so there is a broader tax base. Elasticity, small increase in rates can generate significant revenue as it impact all consumer. Okay, so probably 1 rupees increase in Parle biscuit might not impact me because my paying capacity is up to a certain level. But for a daily wage earner who is earning a limited amount, that 1 rupees increment in Parle might cause him to shift on another kind of biscuit who is charging lesser. So elasticity means because of change in tax percentage, how much the consumption of that product is varying. Elasticity. So a small increase in rates can generate significant revenue. in any kind of product. Behavioral impact, it helped to reduce harmful consumption by imposing higher taxes. Transparency is there, indirect taxes are embedded in the price, making them less negotiable, consumer simplifying compliances. Economic implications, stable revenue source for government even during economic fluctuation. Demerit is that first it is a regressive. There is a potential for corruption, evasion, and cascading effect. Why? Because producer may hinder their production, and you might have seen your surrounding as well that there are many people who are not paying GST or even paying lesser GST if they are liable to pay. So that happens. Regressive है, less elastic compared to direct tax. Direct tax have more elasticity because that directly impact the disposable income of any person. It can make product expensive. Hidden nature of tax reduces civic awareness compared to direct taxes. Why civic awareness? Because if I am purchasing a phone that is costing 10,000 without GST and 12,000 with GST, I might go for payment without GST because that is costing me less. So that is hindering my civic awareness, because even though I am aware that I need to pay GST, but I have to pay higher amount and that I can't afford, so I will be going for payment without GST. Okay, so that reduces civic awareness as well. And increased taxes lead to higher price, potentially reducing demand and affecting market stability. Okay, I have discussed a lot for one session, and I'll be meeting you in the coming session. Let's take a break. I'll be coming back and we'll discuss from this one. And I'll go a bit forward because there is a lot of things still needs to be discussed in this topic. Okay, bye bye. Have a nice day.